Ramona Cedeno, we have been so fortunate to build a partnership with Ramona and her company FiBrick over the last couple of years. Like you all, she is a hardworking small business owner. She's also come to this country in her late teens and had a tremendous career in corporate finance before breaking out on her own to offer both accounting and tax and CFO services to small businesses like you all. She's the one person I know who can actually make a topic like accounting and taxes fun and interesting. We had a great session with her early this year on managing your taxes like a pro. Hi. Oh, look at all these hellos. Great to see you guys. Thank you. So Ramona also does a tremendous amount to give back. She's a We NYC mentor with the City of New York. She serves on trade boards. She also serves on the board of a CDFI, a mission-driven lender called Ascendus. So I'm very excited to have Ramona with us. I'll ask her to come on screen and I'll turn the floor over to her.
Thank you so much, Colleen. Thank you, Alan. Thank you, Mastercard, for putting this event together. And they do so much behind the scenes to bring you this type of content. It's not just what you see here on tonight, it's what happens before to get everyone together, to put together the content and to coordinate with the speakers. So I give them a lot of props for making everything seem so smooth and simple. Tonight, we're going to talk about accounting, bookkeeping, a little bit of taxes in there. Please ask me all your questions. We'll try to answer as many as we possibly can within the time that we have. Colleen will help me coordinate the questions on the chat, and I will go through each of the points that I want to discuss and then make a pause in between so that you can ask me your questions. And I will now just share my screen. So Accounting 101. And we're going to talk today about a lot of different areas within accounting. But before we get there, thank you, Colleen, for that beautiful introduction. I own FiBrick, an accounting practice that provides fractional CFO, accounting and bookkeeping, and tax advisory services. I have many, many years of experience in the industry. I love what I do. I love helping small business owners. I love helping my business. And I really like to share the expertise that I have through these types of workshops, one-on-one consultations, conversations that I have at different networking events. Anyone who meets me can ask me a question, and I'll be happy to answer it right on the spot if I have the answer. I'll send you to the right place where you can get it. And I also published a book called Simple Choices, Big Rewards in Money, where I share my tips and my experiences with managing personal finances. Tonight, we wanted to bring to you tips and actionable steps that you can take to manage your bookkeeping, your accounting, not to do it yourself necessarily if you don't want to, but to understand why accounting is important to the success of your business. Colleen mentioned a lot of other topics that are impactful to the success of the company. You do have to worry about bringing in those clients. So marketing is important. Sales is important. Cybersecurity is super important if you want to provide the right service to your clients. But understanding how everything impacts your bottom line comes down to the accounting of things. Understanding your financial statements is important to know what's in the financials. And before you get to the financials, you need to organize them, of course, and make sure that what is the categories that you put everything in is the right one. And I'm going to speak to you as if you do this yourself, but at the end of the day, you can outsource your accounting, some functions of the accounting services or your accounting processes. However, you as the owner of the business need to understand what is in your financials, how everything comes into your bottom line, and how everything impacts your taxes, of course. I will cover a little bit about tax basics for your small business. We are getting to the end of the year. Tax season is coming up. So as a tax professional, a tax expert, it's really hard for me, and I smile when I talk about taxes. I'm probably the only person that does that, right? It's hard for me to just talk about bookkeeping or financial reporting without talking about taxes to some extent. And at the end, we'll talk a little bit about some tools that you can use to improve efficiency within your business or to create efficiency. And this I always say to my clients and during my speaking engagements that every process that you have within your company that it's manual or that leads to errors directly feeds or take away from your bottom line, right? So everything from selling to your clients, providing the services to that client, onboarding the client, making sure that the client brings recurring revenue, all of it goes to your profits or impacts your profits. Why is accounting important? Why does it matter? Accounting is the science of, it's a science of bringing all the components that make up your revenue and expenses, your assets and liabilities, your equity, bringing it all together in a way that's organized and usable to take action or to understand how a business is doing. And you can do accounting for your personal finances too. For businesses, it's key to pay attention to this area of your business because it helps you with growth and stability. It helps you assess how the company is growing or not growing, what factors are making it grow or not grow, and also how does the financial aspects of the business impact the stability of the business. Having good accounting practices or bookkeeping practices help you avoid costly mistakes. And when we say costs in relationship to something that's not accounted for properly, we're referring to costs that can come from overpayment of taxes or non-compliance with the reporting requirement, mixing personal expenses with business expenses, and in an audit that will result in penalties and fees for you. And sometimes it just prevents you from being ready to apply for a loan or to seek other type of financing. So not having good accounting processes and financial statements can lead to costs because you might not be ready to apply for a loan, to file your taxes on time. You might overpay, you might underpay, which also is not good when it comes to tax filings. And financial statements that are organized help you with strategic decisions. Looking at these financials that we'll go through them in a bit, but like going through the process of good bookkeeping throughout the month, preparing financial statements that align with your business industry, your business model, and your business goals, give you visibility into what decisions we need to make to pivot, to refocus, to hire, to cut down on expenses, whatever the decision is that we need to make our business more sustainable, more stable, to help it grow. A lot of it is in these financial statements. Any comments so far, Colleen, or questions? I see a lot of chat there, but
a lot of great companies we're hearing from all over the country. We did have one very specific question in the Q&A that we might want to hold on. We'll leave it up to you, but there's an ask about information on the Corporate Transparency Act and any related penalties. Should we hold on that till later, or?
Let's do it later. Yes, let's do it a little later. Remind me.
Yep, I will.
So what is bookkeeping? This is one of the topics for tonight. I talked about accounting earlier, and sometimes there is this mixing and matching of accounting, bookkeeping, taxes. When you ask about, when you tell someone, I'm an accountant, business owners think that you're a tax person. And when you say you have a bookkeeper, you might think a bookkeeper is like a specialized area within accounting. It's just a term. So let me walk you through at a high level. Accounting covers a lot of different areas. It's your accounting, is the analysis of the financials, preparation of the financials, making decisions from a profit and loss or revenue and expenses point of view. And then looking at the end product of all those pieces that came together, which is your net profit, your net loss. You also have your balance sheet. How many assets does the company have? Liabilities that it owes to vendors, the equity. All of that is what we call accounting. A lot of times when we think of bookkeeping, which is the categorization of every bank activity that comes through your bank and credit card transactions, categorizing them into different buckets, it's part of accounting. It's part of financial reporting. So in day-to-day life, we say bookkeeping, but it's more than just bookkeeping. It's analysis of financial statements. It's understanding how we want to, what decisions we need to make to improve the revenue, to improve the profits. That's the accounting. It's how we use this data to make decisions and understanding what went wrong or what is working from a financial performance point of view. But the bookkeeping, the day-to-day bookkeeping is, let's make sure our bank transactions are posted correctly. If you have automation, let's automate that. If you're using something like QuickBooks or Xero or Wave, we can semi-automate some of the categorizations. And there's a lot of YouTube videos on that. But the idea is that we are reconciling our bank accounts on a regular basis, and that is bookkeeping. And you do this in QuickBooks or, like I said, Xero. Some small businesses or small business owners do their bookkeeping in Excel or not at all. They just look at the bank account and they see that they have $50,000 and okay, I have $50,000 left. That means I'm making money. That doesn't necessarily mean that, because you could have 50,000 that is made up of some revenue, some loans, some money that is yours that you just, loan to your business. So the bank account alone is not a way to manage your finances. It's important to have an outside system that where you can track things by category and monitor in a regular basis. Now, the bookkeeping connects into accounting or with accounting because it provides the foundation to prepare reliable financial statements. But just categorizing transactions, bookkeeping alone is not truly accounting, because when it comes to the accounting, it's also understanding what the financials are telling us. So that's just the different terminology that we may hear when we talk to accountants or bookkeepers. Now, taxation falls under accounting, but it's just a different type of accounting. Tax. So when someone says, I talked to my accountant, it's not always necessarily a tax person. It could be a financial reporting accountant, like bookkeeper/financial statements person, or it can be a tax accountant. The impact of bookkeeping in the success of a business is good bookkeeping ensures that you have good financial statements, which helps you make better decisions and assist with managing tax compliance. The better your financial statements are, the more accurate they are, the easier it is to file those tax returns at the end of the year. But it's not just about filing the return, it's making sure that you're not reporting to incorrect data or reporting too much, more than you need to or less than you need to if you have misclassified something. I'll post again. Colleen, any questions?
Nope, nothing else other than a question about the recording, which I'm answering now.
Okay, great. So as we work on our bookkeeping on a monthly basis, the end goal is to have these beautiful financial statements that we hear of as we network or with our accountants, which are the profit and loss statement, which is also the income statement. So profit and loss, P&L, or income statements, it's all the same. The balance sheet and the statement of cash flow, or the cash flow statement, as we say here. The profit and loss is going to show how the company is doing or has done as of a point in time in relation related to your revenue and the expenses for the business. So in summary, the profit and loss is going to show you the summary of total revenue, total marketing, total insurance expense, all the expenses that are necessary to run your business and that you have incurred during the period that you are running this profit and loss statement for. So profit and loss can be run by month, for just 1 month, by quarter, and for the year. And when I say that the profit and loss can be run by X amount of periods or for X amount of periods, this is under the assumption that you are using a bookkeeping tool. If you are still doing your bookkeeping in Excel, you would be, which I don't encourage, but assuming that there is someone on this webinar that's doing this, you would add up all your revenues for a given month or for a given period in the year. You add all the revenue, all the expenses by certain categories, and your revenue minus your expenses will give you your net income or your net loss. That's what the P&L is, profit and loss. All your profits or your loss or your expenses is equal to your losses or your net profit. And then within those different categories, you have cost of goods sold. These are the costs related to the production of your product or directly related to the delivery of your services. And you have interest expense, taxes, different categories of expenses. On the balance sheet, you will have your accumulated cash or leftover cash, net cash balance as of a given point in time, your assets. If you have purchased a big piece of equipment, it might be on the balance sheet. That is accounting. So when we talk about how to categorize an asset, that we fixed asset that we purchase, a car, printer, there are different ways to account for it. So generally you need the help of your tax accountant at least to help you with that, unless you have a bookkeeper that's doing that. You also have on your balance sheet your liabilities, how much money you owe to others. If you took a loan, you would have put that loan balance on the balance sheet. And I'll show you some examples of how the balance sheet looks in the P&L. And then the cash flow shows the cash in and out in a given period. And in some cases, I get, sometimes I hear clients say, oh, that's like my profit and loss statement, right? Because profit and loss shows your revenues in and expenses out. But the profit and loss compared to the cash flow statement, the difference is that in the cash flow statement, you will have other cash in or cash out that doesn't relate to your profit and loss statement. That doesn't come from revenue or expenses. For example, if you received a loan from CDFI or the SBA, you have gotten this loan for $50,000, for example. That $50,000 does not go to your profit and loss, but it does show up in your statement of cash flow. So that's the difference. The cash flow is all the cash movements in the business, and the profit and loss is revenue and expenses.
Hey, Ramona.
Go ahead.
Just wanted to also mention that, all of our research shows how critical cash flow is to small businesses. And so can't emphasize enough the importance of this one piece of reporting. And I'm really glad you made that distinction between the two.
Yeah.
We did have one question. Again, we can hold it till another point in the, in your presentation, but folks are asking about, aside from your own services, what software tools you might recommend for small businesses. I know the fundamentals are still critical. If you don't have that, the software is not going to figure it out for you, right? But do you make any recommendations, or would you prefer not to?
Of course, this is product agnostic, right? Of course, no, I'm here to put you in the right direction. That's what we're here for. So I have at the end a slide where I share some bookkeeping tools And so when we get to that slide, so I'm making that person wait until the end, even unless they have to leave early. I have some tools that I want to recommend, and I'll mention other resources that might be good for starters. Is that
Awesome. And we had one request from Marie. I'm sure others are thinking the same. Could you quickly repeat the definitions of these three: P&L, cash flow,
Yes, yes.
balance
So
sheet?
the profit and loss reflects the like I say, the company performance, the results of the business from revenue and expenses. That's a profit and loss. Profit and loss is how do we get to net profit, or how do we get to a loss? And that is based on revenues minus expenses in a given period. So you can have a profit and loss for just the month of November, just because you want to see your profit and loss that month, or you can run the profit and loss for all of 2024. You can, if you are using a bookkeeping tool, you can run a P&L for last year, this year compared to last year, for the last 5 years, if you have been using the tool that long. So being on a bookkeeping tool helps save so much time when you have to look at how did the business do over the last 5 years, the last 3 years. When you're applying for a loan, they ask you for your P&L for the last 3 years. It's right there. You can run it if you have done the bookkeeping within the tool. The balance sheet shows the position of your assets and your liabilities, and also the equity, the accumulation of the assets and liability. The net of that, assets minus liability, is your equity, and there is a way to get to that on the accounting side. But it's really, if we're comparing the profit and loss to the balance sheet, imagine that you get $10,000 from a customer this month, and that's the only thing you have. 10,000 will go to your profit and loss as revenue, and it will also go to your balance sheet as cash. So if you only had that one transaction in the month, your profit and loss will show $10,000 of profit because you didn't have any expenses, and your balance sheet will show $10,000 in the bank. So that's how the two are built: is you add revenue to the P&L, you add cash to the balance sheet. You make an expense, you pay an expense that decreases your profits. It goes in your P&L, it reduces your cash. So the two of them are very close related when it comes to cash movement. Other things that go on the balance sheet, as I mentioned before, is if you receive cash from a bank, it goes on your balance sheet because it is cash that you received, that is not related to your sales of a product. It goes in your balance sheet in cash. So cash increases by 50,000, but your liabilities, your debt to others, also increased by 50,000, and that's only on the balance sheet. So that's the relationship between the two, and those are some of the examples of what just happened on the balance sheet. The statement of cash flow will be a movement of all those pieces, all those examples that I mentioned. Revenue coming in will go in your will show up in your cash flow. A loan that you get from the bank will also show in your cash flow. So I explained it with examples, but hopefully that makes a little sense.
Thank you.
You're welcome. Good. So here, I think what I have now is an example of how your P&L might look. This is very condensed, but I'll try to explain so that we could fit it here, but I'll explain some of the pieces that you can expand. So we have revenues over here. We have cost of goods sold. This is just an example. Cost of goods sold is the costs that are directly related to the production of a product or to the delivery of a service. So basically, it's a cost that if you get rid of the product, if you don't produce that item, you don't incur this cost. And the best example I can use, I always say, is like in the service space. If you have a school and you teach a class every night and you charge $100 for that class, and you have to hire a teacher to teach the class and you pay the teacher $50, that would be what would be in this line, right? So I need that teacher to teach that specific class. If I'm creating shampoos, I need certain ingredients to create that bottle of shampoos. That's the direct cost of that product. But then you have indirect expenses that are not directly related to the product or the service. Your insurance, your marketing, all those are considered operating expenses that are not part of this line. They're not part of cost of goods sold. They'll be part of other operating costs here. Now, this line up, other operating costs, will be expanded if you have an accounting system, or if you're doing this in Excel. You will have multiple lines for operating costs. You'll have, like I said, insurance, marketing, and other items. You have interest income or interest expense. Those are other categories. Tax expense. And at the end, you get to your net income or net profit. That's a very high level of this. These are some other things that we can calculate: gross margin profit, gross profit margin, operating profit margin. But that's for our KPI webinar. I'll skip those now unless anyone has questions specifically about those. But this is the P&L or income statement.
Don't see any specific questions on those.
Okay, great. Now let's talk about the balance sheet. This is what I explained without the picture before. So the balance sheet is going to have show the accumulation of your assets. And when I say accumulation, it's ins and outs. So like you increase cash, but sometimes it decreases because you have to pay the expenses. So this is your net cash position as of the end of a given year. Accounts receivable is the monies that are owed to you by your clients. If you don't use an accounting tool where you do the billing for your clients, you may not see this number. And when you run your balance sheet, and let me add that again, when you have an accounting tool or bookkeeping tool, these reports can just be run in those tools. You just say, let me run my balance sheet as of today, and it's going to be there, assuming that you have categorized everything prior to running that report in the proper way. That when you get cash, you put it in the right bucket. When you made an expense, you put it in the right bucket. If you're using QuickBooks, there are classes that show you how to use QuickBooks. Many organizations have these trainings. QuickBooks may also have it available. So I'm not going through the mechanics of how you post bank transactions in QuickBooks, but that's something that you can find easily. Go ahead, Colleen.
We have one question about assets. This is a really interesting specific. Billy has a new business. Billy's husband builds furniture and built some furniture for the new business office. The materials were covered, but does the furniture need to be considered assets? And what a good guy, right, for building furniture for the business.
Yeah, so it sounds like they're manufacturing the furniture.
No, I think the business owner's husband just built some furniture, as he does for a hobby, for the new business office. I'm not sure what the business does itself.
Okay, so I see. That's very nice. I get no, now I get it. What you said, that was very nice. So this is interesting. I never heard anyone doing this for their own business, but I know what I can tell you about the accounting. So if let's say your husband purchased all the materials to build this piece of equipment, the cost of that equipment is, or furniture, is the sum of all the materials that he purchased to create the piece of furniture. If you want to reflect it on the balance sheet, and he's not part of the business, this is kind of a gift to the company. So they'll have, or to you, so you have to talk to your tax accountant to see how you can position that in a way that becomes part of your company's assets, and you can do the write-off. I mean, if you're a husband and wife, there's a gift to you, you can donate or contribute a piece of furniture to your business, and it becomes a contribution from you to the business rather than a gift from him to the business. So there are ways to position that. But yes, the final cost of that piece of furniture could go on your balance sheet here. And if it was a contribution from you, and a contribution is like when you put money into your business and you can put assets into your business, that contribution would increase the asset side of the balance sheet around here, and then it would be a contribution from you in your capital account. So your capital account, how much you have contributed to the company, increases because you gave this piece of furniture to the business as a contribution. So I hope that answers the question, but there is some mechanics that have to happen before we get here so that you can respect this.
Yep.
Yeah, it cannot just, if it's a gift, then we have a different accounting, tax issue to deal with. So talk to your tax accountant. But that's a very interesting situation and question.
Thanks, Ramona.
You're welcome. All right, so now this is the statement of cash flow. It is really hard to do this on Excel manually. I would never recommend it. The balance sheet is also a little tricky because with the P&L focuses on a point in time. You just, the P&L is the profit and loss. You just add your revenue, your expenses for this period, and you're done. But when we get to the balance sheet shows accumulation of transactions that impacted cash, receivables, inventory from the beginning of time. From when you open your business, this is every cash movement that happened in this business over the last 20 years would be here. If this was clickable, I would be able to open this 81,000 and see history from the beginning of time. And the same thing with your equipment. It doesn't mean that it continues to increase because at some point you remove items from here, but you have the live to date activity in one of these accounts. It's really hard to do this manually. So most businesses that do their bookkeeping in Excel, they only focus on the P&L and they don't have good visibility into what does my balance sheet look like or should look like if I had one. And they don't have visibility into the cash flow statements for a long period of time. You could do a cash flow analysis just for the month of November, maybe for the year, by adding all your cash and subtracting your expenses. But that's really hard to do in Excel. I mean, it's really hard for us to do it, to understand it and explain it. In coming from a financial system, I imagine doing it in Excel. But if you do have QuickBooks or Xero, you can run this financial statement. It's typically divided into 3 categories. It shows the cash flow from operating expenses, which means how much cash did my business bring in from revenues and expenses that were just part of normal operations. How much cash did I get from investing activities? And this is if you purchase a big piece of equipment, let's say you're in the trucking business and you purchase 10 trucks, the purchase of that cash outflow or the cash payments related to that, they will go in this section. And then financing activities would be here, including loans. So if we borrow, we would put that cash inflow here. As we pay down, it will go in that section. And at the end, your ending cash flow, your ending cash would agree to your bank statement. And I don't know if these are related. No, these are not related. But when you do if this was for the same company, the cash amount here would be the same one that we have here, if it was for the same periods and the same company. So that's how the 3 of them connect. This over here would be from your P&L, from your profit and loss statement. Everything else that's not on the profit and loss will be on your balance sheet also. and including the net income piece. The net income flows through the balance sheet, and this will be balance sheet only. And then your ending cash connects back to the balance sheet. So a lot of small business owners are not exposed to the cash flow as much because sometimes in bookkeeping, this one is skipped. But like Colleen said, there has been more and more focus on this statement because it tells you if this is prepared detailed enough, like this is summarized, but you can expand when we get to, let's say, 2 loans. You can have the loan from SBA and the loan from Bank A and the loan from, you can expand those lines and then see where's my cash coming from. When I look at payments, when I look at the net income, I go back to my net income and I can see why did I make $100,000, right? And the more you understand the statement with your accountant, if you have one bookkeeper, the more the clearer it comes how much cash you need to sustain the business, how much cash you have left. And you can do that from the balance sheet to some extent, but the ins and out of what is eating away my cash, is it just accounts payable or is it interest? Is it, repayment of loans? A lot of that information can be easily found on the statement of cash flow.
So speaking of cash, Pamela is raising capital for their startup and is asking about how such investments, I guess equity, early stage equity investments, would be categorized.
And this is what type of company she can add does she have?
I don't know. Pamela, can you tell us? Let's see if you put it in the chat earlier.
Maybe a C Corp.
Healthcare company.
Healthcare, but is it a C Corp or an S Corp partnership? I'm curious about that, but I can answer to some extent. So,
LLC.
LLC. And she's fundraising from investors?
Sounds like it. We are
Okay.
raising money.
Yes, so that is important. It was important for me to know this because if you are an LLC, you're not issuing shares or you're not giving equity in the same way that a C Corp would. The only way you can give equity in exchange for financing in an LLC is if you get partners, members of the LLC, and then it becomes a partnership. If you are fundraising and they're not getting equity, your investors, you might be doing a SAFE or convertible notes. That is not really equity yet, but from a reporting perspective, this cash will go on the balance sheet somewhere. If it is a loan or convertible note, it will go on your long-term liabilities here. So like this 50,000 could be some fundraising that you did. That is some note that's going to convert to equity when the company becomes a C Corp. I've seen that scenario where a company starts as an LLC, starts fundraising, and the investors expect to own shares one day of the company. And the idea is that the company is going to become a C Corp. So temporarily, the fundraising is considered a loan. Convertible note, which means that it's going to convert to something at some point, which is going from loan to equity. If you are truly giving equity in exchange for the fundraising, that will go in your equity section. And if you are a C Corp, this line here will be broken down into common stock, preferred stocks, depending on how the terms of the equity fundraising are defined or agreed upon on the agreement. If you are fundraising from partners that become partners in your partnership, then it would be like partners accounts. You have contributions from different members of the LLC. So without, there is a lot more that needs to be considered there, like when it comes to the type of entities and the long-term goals of this investment. But in summary, fundraising typically go on your balance sheet, and it would be in equity and cash, right? Because you get 50,000, increases your cash by 50. increases your equity by 50, or debt and cash. Increases your cash by 50, increases your debt by 50. Hope that helps. Any other questions, Colleen?
There is one. I've just asked for a little more detail. Marie has a consulting business and produces products or services that they believe have IP value to them, and is wondering if such a product or service is considered an asset or only when it is valuated as a commercial type product. So Marie, if you can put any further details or an example in the chat or the Q&A, let us know and we can clarify that with Ramona.
Yes, and I'll try to start. So typically you separate the IP from the product. So the product itself that you're creating that's ready for sale, if it is a product that it become an inventory, you have that as inventory, and then you sell it, it becomes revenue, and inventory decreases. So that's if you have a tangible product or software that you're building. If you have an IP that is patent, that has a patent or some other type of value add, a process that you have gone through, typically that is not on the balance sheet because you haven't paid for it, unless you purchase some components of it. Like if we bought, let's say, a domain that's highly valuable, you bought it for $1, but now it's worth $1 million. There is some accounting entries that happen. That's for much larger companies. Public companies definitely have to do this. They would have to revalue that asset and show on the balance sheet the value of it, and then the fair market value adjustment goes somewhere on the P&L. Yes, that can be a situation that you can find yourself in. Otherwise, as a small business, many times this revaluation is not done. And then when you sell the company and this asset, this IP or trademark or name or domain has increased in value, when you sell the company, there is some calculation of the gain on that asset because you purchased it for $1,000 and now it's worth $1 million. There is this big, gain that you will have to treat in some way, accounting-wise and tax-wise. That can get complicated, and it requires a lot of tax planning, so you don't end up paying tons of money. But that's the short answer. Did she add anything?
Yeah, it sounds like the product is developed by Marie. The example is the development of an algorithm, say for analytics purposes. That sounds very technical.
Yes, some of the R&D expense, research and development of this product, of this algorithm, the expense related to it, even your payroll and some other resources that you're using, can go to the balance sheet from the beginning. That is a complex accounting process and question that, yes, you will need to discuss with your accountants to help you figure that out. But I'm glad that she's asking these questions, because there is a lot there. When it comes to developing something like that, or a new product or a new process, new software, the research and development expense related to it can lead to some research and development tax credits. So if you are accounting for this properly, you can then potentially apply for that tax credit. But I'm not going to say more on that because it can get very complex and technical, but I'm just making you aware that that exists, and I suggest looking into that further.
Great, thank you.
You're welcome. Oh, great questions. Okay, I love this part, and usually I start with this, but I'm glad it's here after all these conversations that we had already. These are the essentials. I always repeat this at every event that I have because I still continue to see some of the same patterns in today's accounting world. And for good bookkeeping, the first thing you need to do is separate your personal and business transactions, bank accounts. They should not be commingled. Is, some accountants will say you're breaking the corporate, what is that, veil? Like when you do this, I'm not gonna get to that. It's not like I'm not gonna scare people about the legalities of commingling, but from a tax perspective, if you commingle personal with business, it's really hard sometimes to determine at the end of the year, have I accounted for all my business expenses when I have purchased or paid for many of them with my personal credit card? And now my business account doesn't show that. If I'm doing bookkeeping in Excel, I'm only tracking my transaction from my business bank account, but I know I paid a bunch of things with my personal credit card. We have a hard time categorizing one bank account and reconciling one bank account. Imagine having to go through the many credit cards that some of us have. I have a lot, and I use them for different reasons. And sometimes I go on a business trip and I'm trying to use my business card, and they don't accept Amex, or the card didn't go through because I was in a new state and I had to use my personal card. And then at the end of the month, I'm like, which one did I use when I was in Vegas, when I was in Florida? What I do to make this easy, when I have to pay something with my personal card, I have my receipt handy. It's like when we used to work for corporate and we had to prepare an expense report. I do something similar with my expenses that are my business expenses that are paid with my personal credit card. I bring my receipts all in one little pouch, and everything that is my business account is easy. I categorize it. The ones that are not on my business account, I actually go into QuickBooks and I create like a little entry that says I pay this on behalf of business and business owes me this amount, or I'm categorizing that as a contribution. They don't have to pay me, but the business doesn't have to pay me back, but I contributed this $100 into the business. If you are doing your own bookkeeping, this sounds complex. I would say you just talk to your tax person, and they will give you, either will tell you, create a log. This is what I'll do with you, right? Create a log of all the expenses that you cover with your personal credit cards. Do it at the end of the month so you don't forget. And at the end of the year, send me that list, and I'm going to incorporate that into your tax return, and or even your QuickBooks, if you have one, and create a journal entry for you. That's one of the options they might give you. The other option they might give you is, let me show you how you do this so that you can do it next time. We record it, we write the steps, and then you're an expert at creating your own journal entries in QuickBooks for your expenses paid with your personal credit card. But the best thing to do is to try to never have to be in a situation where you have to do that. So if you can have 2 credit cards for the business and always alternately doing those 2, and those 2 credit cards are connected to QuickBooks and you're categorizing them monthly, you're way ahead of the having to clean up at the end of the year game.
And if you always use a Mastercard, you won't have any issues with American Express acceptance.
My gosh. I set you up for that, Colleen. The commercial.
Sorry, we don't do commercials in this series. I couldn't resist though when you mentioned it.
It's funny. I usually say Mastercard, right? And I forgot today. I love Mastercard. I have so many cards from Mastercard. But I do know that sometimes the Amex is not used with some vendors. So that's why I use that as an example.
In all seriousness, there is one follow-up question. Mary is asking, how do you show or justify that you sent money from a personal account to a business account?
Very good question. So if you are, and I was going to talk about that. So if you have to lend your company money, or vice versa, the business needs to give you you have to take a draw from your business. And this only applies if you are draws from your business or distribution from your business. Only apply if you have an LLC, sole proprietorship, or S Corp. If you're a C Corp, there is a different process for that. We don't just borrow and lend money to our C Corps. They're supposed to be like completely independent from their owners, where the owners is supposed to be an employee. So if you're taking draws or lending money to your single member LLC, your S Corp, you do a bank transfer, clean. I like round numbers, so it's easy to identify 1,000, 10,000, 5,000, back and forth. And when you're doing your accounting, your bookkeeping on the business side, you are going to see this money either leaving or coming into the bank account. That is a balance sheet item. So, and the reason I say this because we're talking about the balance sheet. That's not income, and that is not an expense. Expenses, when you take money out of your business as for yourself, the only time that's an expense is if you are an S Corp and you're taking money through payroll. So if you're on the company's payroll, that is an expense to the S Corp, and only the S Corp will have you on payroll. The LLC, you wouldn't be on payroll. You would be on payroll, that's an expense. But going back to the question, if you're just taking a draw from your LLC, a single member LLC, or S Corp, that is a balance sheet item. It goes to your distribution account on the balance sheet. And whenever I say something goes on the balance sheet, the idea is that you will have created the category beforehand called distribution. It's mapped to the balance sheet. It's that simple. The categories are created in the system when you start using it. You create a distribution account, link to the balance sheet, and then every time you take money, it will go to the distribution account. If you contribute money to the business, which was the question, when you see the money in the banking tab in QuickBooks, you would categorize that as a contribution from the owner. Owner's contribution, owner's investment. Sometimes the name is varies from one business to the other. And then how you trace it, how do you prove that that is your money, right? That you're putting in? It's just the day you book the transaction, it's going to have the transaction date. It's going to show that it came from you somehow in the memo from the bank. It has either your name or the account number where it came from. And you can also add a little memo there, say loan to the company or contribution to the company. And you have the other bank statement that shows the money going out, right? So that would be the way to prove it. And that was a long answer, but the only time you might find yourself in a situation where you have to prove that is, let's say you deposit a check instead of making a transfer and you are under audit. The IRS doesn't know by looking, or whoever the auditor is, they can see that deposit came from you because it was just a check someone deposited there. So in your bank statement for the business, it just says deposit. I wouldn't encourage just to deposit a check. A transfer that can be traced through the memos. But if you do deposit a check, keep a copy of the check with the date, and that's your record. And I overextended the question, but it was a good one.
No, thank you for answering, Ramona. Before I get to the next question, I want to confirm that we have enough time to finish off the slides and you're able to stay past 7.
I don't know how much what time is it, Alan?
It is 7 right now, 6:57.
Okay, yeah, so let's go a little longer, and yes, I'm okay.
Okay, do you have any slides to go through? Or do you want to ask
yes,
a
let
few
me
more
see.
questions?
Yes, let me just go through this. I don't think I have that many. If you are getting ready for tax season coming up, make sure your expenses are categorized properly. Everything that we have discussed before, through the bookkeeping tool or in Excel, if you're organizing them, do it now. Take the holidays to do this. I know some of us are going to be working on our goals and year-end resolutions. Take some time to get ready for tax season. Save your receipts, your contracts. That's just for in case you need to show it to your accountant. Most of accountants won't ask you that. They don't have to, but they can. If you come to me with $50,000 in rent for an office or business that doesn't seem to require a $50,000 rent, I will ask. And if you say, oh, here's my contract, here's my lease, I'll take it. And also having the support handy will help you be ready if you ever have to reply to an audit request. And this come up from time to time. You move from New York to Florida. New York wants to see proof that you moved and when. And there are different situations where you might get a little inquiry from from one of the tax agencies. So have all your documentation organized, dated, notes, and all that. I think I talked about this. Oh, this is about taxes. It's important to stay compliant with your tax filings. You avoid penalties, you avoid interest, you avoid just being, the bad list of and the not so great list with the IRS and all the tax agencies. They remember everything. They will have records of when you didn't pay on time or when you didn't file. So let's make sure that we stay compliant with that. And some deductions that I wanted to bring up. Someone mentioned equipment. So let me just mention something about this. If you buy any equipment or computer equipment, furniture before the end of the year, there are some rules within the IRS that allow you to take the expense this year for the full amount of that equipment or that piece of furniture. So let's say right now your net income is $100,000 and you're trying to reduce that to a lower amount because you want to pay less in taxes. You can go out and buy equipment that you need for your business. A computer, a printer, an office, a chair for your home office. As long as you need it to continue running your business, or you're going to need it next year, you can buy it this year and you can reduce your net income that way. Home office deduction. If you work from home and you have a dedicated home space for your business, you can take a deduction for that, and your accountant will help you calculate that when the time comes to file your taxes. Just ask them about it, and also just say, I know work from home. Can I get my deduction from the home office? The other thing is if you have if you pay for your health insurance out of pocket, if you're not in your spouse's work insurance, but you're paying on your own and you're a small business owner, S Corp, single member LLC, sole proprietorship, you can deduct the cost of health insurance as self-employment health insurance. Also mention that to your accountant, because a lot of times that's not paid with the business account and it can be overlooked. To manage your cash flow, we talked about cash a lot before. Bill timely, collect timely. Don't wait too long before you ask your clients to pay you. And bill timely at the beginning of the month. If you bill monthly, consistently, let your clients know that you're there, you're present, you're not forgetting about your money. Be ready to apply for a loan. And this means have your financials in order. Mind your score, your credit score. Make sure you're building a good credit score for yourself, for your business, and that you are utilizing the credit that you have in a smart way, because as we use it, we increase the lines of credit. If you have a line of credit or a credit card with Mastercard, use it every month, pay it down, and they will allow you to increase the credit that you have access to over time. So when you really need an increase, you need a bigger loan, a bigger line of credit, you have the history that supports you getting that increase.
Nice touch there.
Yes. Anything else you want to add there, Colleen? No? Okay.
No, thank you.
Try to build that emergency fund. We're saying here 3 to 6 months worth of operating expenses for unexpected events. What this means is that if you have expenses that you cannot get rid of in the case that your revenue decreases. So I talked about the fact that you have the school, you have a teacher. If you don't have the class, you don't have the teacher, assuming there are contractors. But let's say you have an employee that you want to maintain even through tough times, or do you want to keep, or you have an office that you're stuck with because you're in a lease. Those expenses are not going away just because your revenue is going temporarily away, hopefully. So having that emergency fund reserve of cash will help you survive during those months. It could be also as simple as you have a big contract and the customer or the client doesn't pay you timely, and you're strapped. You don't have enough cash to support the business during those months. Having a line of credit that you can have access to can help you survive. Get through those months, but also having that reserve of cash is also very important. So if you have a line of credit, make sure that it stays open, that use a little bit here and there so they don't close it and understand how the bank works when it comes to it. Do they want you to use it, not use it? Do they care if you have it unused for a few years? Are they going to close it? So just don't ignore your credit and your credit lines. And these are some of the tools that I mentioned I was going to talk about. Some are more advanced than others, but we're here. So QuickBooks, most small businesses will be in this column. QuickBooks Online is great. Xero is also really good. Wave is free. So if you're going to do your own bookkeeping, Wave is a good way to start. We also have FreshBooks. We have many others. I think Zoho, but these are the most popular ones. These are for growing businesses. When you outgrow these three, some businesses go to these ones. And then for tax preparation, I wanted to share this in case there is anyone that's doing their own taxes. Credit Karma now has a nice, easy to use tax prep app. My brother used it the other day, but he doesn't have a business. So you have to see like which one is the better fit for you if you're doing your own. There are some, depending on your income, you might be able to do your taxes directly on the IRS website if they are simple. Just keep in mind that if you file on the IRS website, that is not necessarily filing your state. So you have to ensure that you're doing your federal, which is IRS, your state, and your city if you're doing your own tax returns. And there are some organizations that provide free tax prep services, some volunteer organizations. I don't have all of them, but if you Google, you might find some. And most of them work based on the income level. That there's an income threshold that you need to meet or be under to qualify. There are other tools here, Bill.com for automating your vendor payments, Expensify for expense reports. And what I don't have here is payroll. Payroll systems, I really like Gusto, Gusto, if you are going to start hiring, but there are a lot others out there. But I just love Gusto and we use it a lot. And I'm also on their advisory board, but competition to them are JustWorks, QuickBooks Payroll, TriNet, Paychecks, and ADP. And here, connect with me, download, if you scan this QR code, you can download some resources, not just what's listed here. There is a lot you can get in our website, and you can always schedule a consultation if you are looking for this to learn more about our services, and connect with me on social media. And I really appreciate the engagement. If you have any more questions, I'll stay on for a couple of minutes. The BOI, the BOI question, as Colleen, we have that pending.
Fantastic. Yeah, there's just a couple.
So we have one from Tamara. So Tamara's question is, my husband works as an independent caregiver. He uses that income to fund our LLC. What is the best way to record it or fund another business while using a payroll?
So is the husband in the business too? I missed that first part.
So Tamara says, my husband works as an independent caregiver.
Mm-hmm.
So he uses that income to fund their LLC.
Oh, okay. So if they if they both own the LLC, that money that he's getting from his other business or services, he is contributing it to the LLC. So it's money that he's investing in the LLC. So when this is recorded or the bookkeeping is on, it would be, if there was bookkeeping, it would be on the balance sheet. But if they don't have a balance sheet, they can just keep track of this offline, like how much money he has contributed to the company. And two things may happen after that. He can take that money back as long as it doesn't exceed the amount that he contributed. He can take that back as a distribution, or it's there indefinitely until the day that they need it. But that money it belongs to, it's available for him to withdraw in the future. It's not income.
Right.
But
Thank you. So
let me add, Alan, that he does need to pay tax. He does need to include that income in taxes, in the tax return from the source that he received it from. So that's just a regular income that he gets from the other business. That's income that's reportable in his 1040. Just because he's contributing, it doesn't just disappear. He first has to report it, and then he's contributed to the company. or vice versa. It doesn't have to happen at the same time, but it goes into different places. Go ahead, Anna. Next, if you have.
No, not to rush you. So we have another question, and they're asking about the Corporate Transparency Act and any penalties associated. Are you familiar with it at all?
I am, and I don't know if the person that asked the question before is still here, so please say if you are. I hope you are, but the Corporate Transparency Act was asking or mandating that small businesses reported the beneficiaries in that business, the owners or the beneficiaries, by the end of this year, by the December 31st. There was a tight deadlines, very hefty penalties if it wasn't done. But there was a recent update last week. They made public that there is a litigation going on against the act. So businesses are not required to file this by the 31st or as long as the litigation is ongoing, but try to stay aware of changes, and it's not guaranteed that it's going away. If once the litigation is over, we either have to comply with it or the act disappears. But for now, you don't have to rush to do this by the 31st of this year.
Great. And our final question before we wrap. So Armando is asking, just to confirm, I'm a sole proprietor and I pay my health insurance and out-of-pocket fees from my paycheck. Can these be deducted as business expenses, or does this only apply to other business structures?
It's not deducted as a business expense, but it's deducted as a deduction, as a tax deduction in your personal tax return. So there's a small distinction. If it was in the business, it would be a deduction in the P&L. It should not go in the P&L as an expense, but when you file your tax return, there is a line in the tax return that's going to deduct this from your taxable income. So if you're doing your own tax return, there would be a section that says other deductions, and it'll say self-employment insurance, and you'll enter it there. But it is a deduction for you.
I know I said it was the last one, but we have one more.
Yes.
So in the chat, Mary's asking, earlier this year, Mary added a member to their LLC, but they want to change it and remove that person. How will that affect their taxes?
Oh, so if it was officially done through an operating agreement this year in 2024, and it was the first year, two things may happen. You may have to file a partial year as a partnership. This is almost the end of the year. So before this person joined, you would be an LLC. You will file a single member LLC return through that point in time. So you have tax return 1, which would be a personal return, includes Schedule C for when you own the company 100%. Let's say from January through May. From June through December, you will file a partnership return for the LLC. But this is only if this was formalized through an operating agreement and you had all this formalized. If that never happened, I would say maybe work it out offline where the transaction really didn't happen. That's a legal thing. I suggest contacting a legal advisor for that. But that from my experience, you may end up in that situation where like the transaction was never executed. So maybe it is as it never happened and you stay the whole year as a single member LLC, or it happened and you have to file 2 tax returns. Then if you want to dissolve this partnership, you have to take legal actions to do it. And I recommend you do that by the end of this year, so you don't end up in the same situation in 2025 with 2 different tax returns.
Wow, Ramona, you covered a lot of ground in a short amount of time. Thank you so much. I can't find the reaction tab, otherwise I'd do the applause thing, but I'll give you applause on camera. And
Thank you.
clearly it's compelling to our audience because we've retained the vast majority of folks that started with us an hour and 15 minutes ago. So I just want to reiterate the question that came up is, we can't get the recording out immediately. We're working on getting these up and posted faster, but we will send everyone who registered, if you're okay with this, Ramona, your slides, you had the QR code. I thought that slide with all of the different software recommendations was great. And I hope everyone, all of your businesses have a very successful holiday season, but that you all also practice some self-care. That's hard to do as a business owner, and take downtime for you and your family over the holidays. And we look forward to doing more sessions like this with you all in 2025. Anything else you'd like to say, Ramona?
No, thank you, everyone, and take a few minutes before the end of the year to really take account of what you need to do for the business. And I hope 2025 it starts strong for all of you, and looking forward to having you at another session. And thank you, Colleen and Alan, for this. This was really good.
Yes, thank you, Alan, for your support on this. Thanks, everyone. We'll get an email out soon. Have a good evening.